Welcome back to the Turnaround Boardroom. I am your host, Paul Maskill, and this podcast is for home service business owners who want to understand their numbers better. We stop lying to ourselves. We remove our emotion, our ego, and our excuses, and we let the numbers guide us. We focus on helping home service business owners create predictable profitability and consistent positive cash flow. Today, we have a financial expert with us, and we're going to learn how they actually look at businesses from a numbers standpoint. Again, all of our episodes discuss real businesses. Nothing discussed should be considered financial, legal, or tax advice for your specific situation. Every business, including yours, is different. Today, we have with us Rick Calabrese. Rick is a licensed attorney and CPA in the Commonwealth of Pennsylvania and also has a Master's of Law in Taxation from Villanova University School of Law. Prior to law school, Rick obtained a BS in Business Administration from the University of Pittsburgh. Now, as an M&A advisor at his co-founded firm, Commonwealth M&A, Rick utilizes his unique and specialized tax, business, M&A, and CPA background to assist clients through the entire process from initial planning, structuring, drafting purchasing agreements, and ultimately closing and exiting. So that is Rick. Rick, welcome. Excited to have you here. If
Thanks,
our
Paul.
listeners
Happy to
don't,
be here.
yes, this is going to be a fun conversation. You focus on all the parts, all the moving parts of a transaction, not just the M&A part, but you got the CPA part, you got the tax part, you got the business part. So take that intro and just tell our listeners, what do you exactly do for a home service business
I'll
today?
tell you what I did is I took a lot of tests. I just took too many tests. That's basically what my background is, and I'm done with tests. So that's starting with that. But no, it's great to be here, and good question. So introduce myself a little bit more. So I practice law and exclusively for lower middle market, pass through, closely held businesses my whole life. That's all I've done. That's all I ever wanted to do. My father owned a small business, a blue collar business, and I grew up working with him in the business and kind of saw firsthand the experiences that impacted his life and his employees and our family. And I wanted to make sure I did something that could further, small business, especially blue collar trades businesses across the country. So what we do in my role as co-founder is we basically act as a sophisticated investment bank for lower middle market blue collar companies is where we specialize in. We're generalists, but that's our specialization. So we help from all aspects of the deal, right? From as soon as they say we're ready to go up through the closing. So building the SIM, marketing materials, reviewing the financials, setting up due diligence, working with the attorneys, working with the accountants, finding the buyers, negotiating the deal. And hopefully we all have a celebration at closing day.
Awesome. So let's start at the beginning. When someone comes to you, where usually, obviously, every case is different. Like I said at the beginning, every business is different, including our listeners. But usually, at like what revenue, what profit level do most business owners come to you to get started?
So our company is a little unique in that we're a boutique, Paul. So we only handle 3 or 4 transactions a year, and that's kind of by design. So we can offer our clients the white glove, hands-on approach. You get the owners of the company on the phone. We're only basically working on 1 or 2 or 3 tops deals at a time. So given that, we had to kind of set a cutoff somewhere. So the businesses that we like to represent, plus or minus approximately 4 million in revenue, all the way up to 100 million in revenue. And if you do the math on the, if you assume a 20% adjusted EBITDA margin, that's businesses with the adjusted EBITDA anywhere from say 800,000 up to $10 million. With our sweet spot being, the closely held business owner between 10 and an enterprise value between 10 and $25 million.
And then what do you feel? Obviously, I would say in the last 4 to 5 years, obviously in this space, more and more people are interested in selling their blue collar, their home service business. Historically, really wasn't even on the table for a lot of people. They thought, I'm just going to run this until I can't do anymore. If my kids don't want to follow me, I'm out. But now we can sell these things and they're worth a lot of money. So, with that being said, what's kind of the typical situation when someone comes to you? Why do they actually want to sell their business?
Well, there's all different reasons, but the most common and the vast majority is for retirement. Right? Exactly what you said. Kind of my situation's a great example, right? My father, like I said already, owned a great small business, and I have 2 brothers, and I kind of wanted nothing to do with it. I saw, how much it took out of him and everything else. And, I said, you know what, I'm going to go work in the air conditioning. Probably a mistake in hindsight. I kind of enjoy working outside with my hands a little bit more now in hindsight, but I'm kind of envious sometimes. I'm sure they would say opposite, a lot of the employees, but anyway, um, no, so the owner needs to retire, and their children, unfortunately, where everything's going, a lot of, millennials and younger just aren't interested in not everyone, right? But vast majority. And then, so the business owner's 65, 70, 62 years old, ready to go. And, they have this huge amount of net worth tied up in the business, right? And, just recently, like you said, the valuations have exploded. So, throughout their years, maybe they don't have as much savings or the times were tough, right? 2008, early 2010s. Now things are really starting to pick back up and they don't realize what valuation they can have and there's nowhere else to go. And private equity, especially, is there with open arms saying, we'll take it. And we'll pay you a lot of money for it if it's done the right way and you did the right things. And that's what we help with.
So what so you just kind of alluded to it, like, there's a lot more value in these businesses than there were historically. When you start to engage with potential clients and you're looking at valuations, what are the main drivers that you guys are looking for that either private equity would, find attractive or a local competitor that wants to grow through acquisition? What really drives a valuation in a business?
So there's, we could talk for an hour, obviously, just about that topic, and that's an interesting one too. But I'd say I'll go through a couple maybe. First of all, is the quality of revenue. Not all revenue is the same. Project-based revenue, non-recurring revenue, revenue from, like I said, larger projects. Private equity likes predictable, consistent, slightly growing stream of cash flows. That's what they're buying, right? That's what they're going to pay the top multiple for. So if you're able to position your business where there's a lot of little customers and low customer concentration, so your revenue is better revenue, then it could be, each business could have $1 million of revenue, but the business that has the small recurring customer base versus the business that has 5 or 6 big projects making up the $1 million, the first is much more valuable. So that's number one. Number two is, as an owner, this is probably the most difficult part, is getting yourself out of the day-to-day of the business, right? You need to have a management team in place. You need to focus on strategy, just have the one hand on the wheel, kind of looking at the side of the road, kind of driving, unfortunately, versus, both hands on the wheel every day. Why? Because you're going to leave, you're going to retire, right? That's the plan most of the time. So in that case, if you're gone, who's going to replace you? That has cost, that has risk, and reducing those items increases the valuation of the business. The last thing I'd say is this is also critical, having good, clean books and records. If the buyer can't make sense of your business's accounting, they're not going to pay a premium for it. And you probably won't even get through diligence with the quality of earnings, which is a mini audit, so to speak, that every buyer in the private equity community does before they purchase a business.
Super helpful. So when you first get a potential client come to you, Rick, I want to sell my business. I've been doing it for this long. I just don't want to do it anymore. What's the first thing you guys look at? Just like, you said you're a boutique firm, you're only going to work with three or four on on an annual basis. So what's the number one thing you guys look at to, like, if it doesn't pass this test, we're not even moving forward?
I mean, honestly, the number one thing is the client themselves. How are they as a person? And I hope they're thinking the same about us, right? Are they trustworthy? Do they have a good business? What's their reputation? Right? I mean, that's really kind of where we start and stop, because we want to work with good people and get good outcomes. And 9 times out of 10, that's 99 times out of 100. That's not even a problem based on the people coming to us. But that's kind of where we start. After that, I'd say, what does your revenue look like over the last couple years recently? Buyers want to buy a growing business, not one that's going down. So, it's kind of counterintuitive. You have to sell the business if you want the top valuation when the business is doing better and improving. So we kind of look at trends. We look at that. We look at quality of revenue. We look at, ultimately where we have to land together with the client is on a valuation range, right? Because we only do three or four, and there's a famous saying called the country club multiple. A lot of times clients will come to us either extreme, right? The first extreme is, I thought my business was only worth $2 million, and we're coming to say, hey, no, it's worth 5, 6, 7. Like, oh wow, that's great, and that's an easier discussion. And then there's the other side. right? Where it's like, oh, I just golfed with Rick at the club, and he sold his software business that does SaaS and to Apple for 18 times. Like, I want that too. And I'm like, whoa, let's pump the brakes here. This is what your business is worth. We'll look at it. We'll go over a reasonable range with the client. And we have to say, hey, we're going to try our best to get more than this. And most of the time we do. But if we produce offers in this range, that is a fair offer that we all need to feel comfortable with, pending other things. There's no gun to anyone's head, but we need to feel comfortable in this valuation range if we're going to, devote our time to it also. And that's kind of where we start. And usually sometimes we agree. Most of the time we agree. Sometimes, we say go back, improve the EBITDA, make some changes, and then we'll take it when we're ready. Because you only want to ring the bell once. You don't want to have to do it twice. It's a pain. It's a real pain in the process. Trust me.
So let's get into that numbers part of it. Obviously, when someone comes to you, they already have something in their head. They got a dollar amount or a belief that their business is, great or whatever it is. What are some things that, you see that are either like commonly inaccurate compared to the story you've heard, or, this just isn't as good as the owner thinks it is. What are some of the common themes there?
Right. I'd say it's a lot of times the owners, especially in trades and blue collar businesses, they like to focus on revenue. My business is a $10 million business. My business is a $15 million business. And what they're talking about most of the time is the revenue, which is great, right? There's nothing that's awesome. Like the higher, the better. But, businesses aren't valued based on revenue and in the trades, right? Some other types of businesses could be, but not these types of businesses, right? It's a multiple of adjusted EBITDA. So they can think, they have all this revenue and this and that, and ultimately the adjusted EBITDA isn't great for whatever reasons, right? Maybe they have a management team that's, a little bloated, or maybe they pay too much on operating expenses, or maybe their margin isn't great. So it's difficult, right? You have to check a lot of the boxes, and it's not just revenue. So they'll come to us with that thought, and then we kind of sift through the P&L and do our valuation, and our adjusted EBITDA isn't as high based on the percentage of revenue that they've liked to see. And then we explain to them that's how the business is valued. And sometimes that can trip people up. So what I recommend to all blue collar business owners is, when you speak with your CPA at tax time, especially not just at tax time, but definitely at tax time, right? Have him or her calculate your adjusted EBITDA for you. They should be able to do it pretty simple. And if they can't, I hate to say it, you probably need to find at least another accountant or someone else to help you with that, because they should know it if you want to position the business for sale. And I recommend tracking it monthly or quarterly or even monthly. That's the most important metric as you approach, your 60s or want to retire, to track that consistently and then have a plan. So when you execute that EBITDA, you can move forward. I know that was a long answer to your question, but
No, it's great, because that's really what we want to do on the show is really, most gurus, most experts, most social media stuff is just telling you like the stories you said. Oh, we're a $10 million company, or we've got 15 trucks on the road, or we're doing this. But nobody really talks about the numbers and what the net profit is and what's the cash flow and, what's our
all
gross
starts and
profit.
stops with that, Paul. I hate to interrupt you, but I tell you how many times clients call me and they're like, look at all the jobs we've done. Like, look at our facilities. Look at all this. Look at that. And I'm like, that's great. Like, that's all important. But it all starts and stops with the adjusted EBITDA. And I keep repeating it. And they're like, Rick, I know it's EBITDA. It's EBITDA. I'm like, yes, it is. Unfortunately, I wish, and it's not me saying this. Trust me, it's the buyers, right? My opinion is irrelevant. Paul, with all due respect, your opinion, the client, only person's opinion that matters is the person writing the check, right? I mean, that's at the end of the day, if they don't agree or they don't like it, they're not going to pay. So we need to build the business to please them, unfortunately.
Yeah.
If the
And
goal
you mentioned, yeah. And you mentioned at the beginning, at the end of the day, they're buying a stream of cash flow, and the more predictable that cash flow is, the more it's worth. They don't care how that cash flow is made, as long as it's predictable. They
correct,
don't care about how hard you worked and the 24-hour
correct,
days you worked and the blood, sweat, and tears, and, the weekends lost, vacations lost. They just care, what is this going to do if I pay X, and what's going to
right.
be my return if I
Now
pay
there are
X?
intangible factors that do factor into the multiple, of course, but vast majority of the valuation is going to be what is the EBITDA.
Yep. Yeah. And you mentioned, there are some other factors, owner dependency, mix of revenue. You're doing a lot of project construction type work. That's obviously not as predictable. And if the owner is a big part of it, it's not predictable either. So even if the numbers are good, if it's not a predictable number, then it gets a little less worthy. So let's get into EBITDA just briefly, because I know everybody hears it, but very few people actually understand it. And we don't have to get into like the nuts and bolts and, dissect a P&L or anything. But if our listeners wanted to start tracking this, like you said, on a quarterly basis of, hey, what's my last 12 months of EBITDA? What's just like back of the napkin math? What's that look like for them?
So start with your net income, right? Your net profit for whatever period you want to look at. You say, the businesses are generally valued on a trailing 12-month basis. So look at the last 12 months, add them together, get your net income for that period. Start there. That's your starting point. From there, go in the P&L and pull out the the letters of EBITDA, right? So D, depreciation. What's your total depreciation over that 12-month period? Add it back to your net profit. Next, interest. Do you have any interest expense? Add that back to your also whatever's in that expense line. Add that back. Not much amortization, amortization in a business, in a small business, which is if they bought another business, they have goodwill and they can expense that over time. Taxes, probably not for a pass-through business most of the time, unless you're in a certain state within the P&L, if you're doing it correctly. I've seen a lot of taxes in a P&L before that shouldn't be, but it's an add back. So just regardless, I say I'm not, I'm not your doctor. I do what I'm told here. So, whatever you want in there, we'll look at. So you take those items, you add it back. Hopefully it produces a higher number. That's your EBITDA. And then the adjustments is really kind of what people like us specialize in. That's kind of the unique, subjective things that can increase. So for example, say you're the owner of the business, you have your wife on payroll, right? You're paying her $200,000 a year just to get money out and then do 401k deductions, health insurance, whatever, but she's not actually working in the business. That $200,000 would be an add back. Or an adjustment to EBITDA. So that's one example that would increase things. So kind of look for non-business related expenses that will not continue post-closing, that you have to have support for, right? You have to have support and backup for it in case asked. So those things, back to the napkin, add it all up. That's your adjusted EBITDA.
Love it. Beautiful. Great explanation. Super simple. Obviously, if you guys, are actually looking to sell your business and you hire someone like a Rick, they're going to do it a lot more detailed, but at least to give you a decent range in your mind. So now let's get into like actual deals happening. So client signs on. Yep, we're ready to do this. Oh, we got some offers. Time to get into due diligence. Let's get into like what actually kills deals, because once the potential buyer starts poking around and digging in and asking for this and looking at this, not everything is always what the seller says it is. A lot of times it is, but there are those examples. So what are some deal killers that you see that our listeners could work on to prevent, when they could get ahead of it now, so that when they do go to sell their business, whether it's next year or 10 years from now, they don't have to deal with it?
Right. And I really do not want to boast about ourselves in this, but the question I think is a little on point. So a lot of times when business owners try to sell the business themselves, right, they don't understand all of these deal killers that I'm about to explain that you talked about. They get a fancy offer on a piece of paper, devil's in the details, and then they get into due diligence and it just gets chipped away, chipped away, chipped away. And then they're like, you told me it was 10. Now we're at 7. I'm not selling. And then they wasted all that time, effort, and energy. So what my firm will do is, before we go out to market, right, we have, based on our experience, we kind of know what those deal killers are. So, and we go through them to either say, hey, we're not ready until we fix these things, or we're going to take these things, get ahead of them, present them in a more favorable light, explain them in a way that the buyers know all the information up front. So there are no deal. If they're either comfortable with it or they aren't. Right. And it's going to be reflected in their upfront valuation. So what are these things? It's number one, the financials don't accurately reflect EBITDA. And that'll come out in the quality of earnings every time. So with our clients now, I'd say 9 out of 10, Paul, we recommend the pre-sale quality of earnings every time. And our clients that have done it couldn't be more happier that we recommended it and that we did it. Basically, it's like getting your home inspected before you sell yourself. You know where the leaks are. You can fix them. You can say, hey, look, my HVAC is 12 years old. Price that in. Or, hey, my HVAC's 12 years old. Maybe I want to fix it before I sell. Um, it's kind of doing these things that proactively get ahead of it to avoid the buyer. Then, first of all, the buyer feels more comfortable with the deal because you invested time, effort, and money into a pre-sale quality of earnings. They know when they look at your deal, you're ready to sell and your numbers are going to verify, right? Because the last thing the buyer wants to do, they have so many other opportunities. Their opportunity cost is their most important asset, the buyers, right? So if we presented them a nice clean package with the quality of earnings, they're much more likely to look at your deal harder, increase their multiple, and close faster. So all those things prevent deal killers. I'd say the other thing is just understanding what net working capital is, which we also explain to the client. That's definitely a trip up. Explaining what the transaction expenses will be, explaining a high level tax estimate, all these things that, what's rollover equity, all the things that are in an LOI typically that if you're not represented or don't understand ahead of time could be a surprise and change the economics of your deal such that you don't move forward once you get under LOI.
That's awesome. That's super helpful, and I wanna kinda dig in a little bit further on the financial surprises from the seller side, because like you said, they'll get these offers, especially now, you get private equity offers all the time. "Hey,
All
we'll
the
pay
time.
you this. Hey, we'll pay you this." And like you said, devil's in the details. It might be a $10 million offer, but then you're only walking away with, a small percentage of that, at least at the first, the first go round. You mentioned networking capital. I definitely wanna get into that.
Yep.
But what are some, like, the financial surprises that, hey, you're not just gonna get a check for $10 million and walk away? Usually there are these things like, a networking capital, or there's still a lot of debt on the existing company. What
Correct.
are some things that people might not realize that when they go sell their business that, that's gonna be accounted for from a financial
No,
standpoint?
a great question. So every business that we've sold in the lower middle market is valued on a cash-free, debt-free basis. What does that mean? This is usually a surprise to our clients, so we like to talk about this right up front. Also, so all the cash in your company bank accounts is yours. The buyer's not buying that. So say you have a million, you just like to run heavy on cash. You feel it makes you feel good at night, sleep good, whatever happens all the time. That money's yours in addition to the purchase price, right? So in our example of $10 million, if the client also had $1 million in their bank account, they would walk away with nothing else of $11 million in that instance, right? It's incremental to the purchase price. Now, a deduction to the purchase price is any long-term debt on the business. So, for example, you have a $500,000 line of credit. Think of it like a mortgage on a home, right? When you buy a home or you sell your home, you have to pay off your mortgage at closing. Same here. So you have to reduce the purchase price then by the amount of debt. For also, it could be vehicle debt, right? You just bought 4 trucks. They each have a $50,000 balance. 50 times four, $200,000, right? That would also be a deduct at closing. You have lawyer fees. You have our fee, which also is typically paid at closing, fully tax deductible, but another offset. You have networking capital. So networking capital is by design supposed to be a net neutral event if it's done correctly and you have proper representation, right? No one's supposed to win in networking capital. What networking capital is the gasoline in the vehicle, which is the business, right? When you sell your business and the vehicle to the buyer here, they expect the gas tank to be half full. If it's full, they'll pay you, right? The buyer will for that difference between full and half, whatever that value ends up being. If the gas tank is empty, then you have to fill it back up to half and you have to pay a dollar amount to do that. And what is net working capital? It's generally speaking in trades businesses pretty simple. It's going to be inventory plus accounts receivable minus accounts payable. And we can get into gets a lot more complicated than that if there's deposits and other things, but generally speaking it's your AR, your average level of AR in inventory minus your average level of accounts payable, whatever that number is. That's what you have to produce at closing, otherwise there'll be an adjustment up or down.
That's a great analogy. I've never heard the gas tank analogy, and I've had a lot of these conversations, so that simplifies it
I
for
can
everybody.
think of that. I can't. That was my business partner Joe. If he'll listen to this and probably make fun of me, but I got to give him credit for that. That was a
Awesome.
good
Well, tell
analogy.
him great job, 'cause it like you said, it should be a net neutral event if the business is run properly and the deal is structured properly. Obviously, a lot of
We
times
do
it's not, and the seller feels like, "Well, I'm just giving all that up."
right.
But if it wasn't, like you said, I think that's also just, going back to what we said of what can we do now to prepare for it, even if we're gonna sell in 5 to 10 years, making sure your receivables, payables are accurate, make sure you're tracking everything. Um, all that. Cause I'm sure you've seen it where I see with our, clients, potential clients, they might track their receivables, but they don't track their payables, right? Like they're just paying bills when they come in, but it's not on their
Yeah.
accounting system. And then
Some
all of a
kind of
sudden it's like,
cash bait, like modified cash, and it gets all
right.
complicated. Yeah, yeah.
And it's like, but
Um,
wait, I got all these bills that I still have to pay over here. And it's like, well, you didn't tell us about any of those. So, but those are some really good, financial surprises. The debt thing I think is huge. You're selling it debt free. So if you listen to certain CPAs and they tell you, oh, you had a great year, go buy a bunch of vehicles, and now you've got a bunch of vehicles with big notes on them, because you didn't want to pay taxes, even though you're still going to pay a bunch of taxes.
yep.
You didn't want to pay. You want to pay less taxes that year. Now you got all these
The
vehicles with.
deferral too, right? It's not like it's free. It's just a tax deferral. That's what people.
Exactly. So I'm glad you and I are on the same page of that, because there's
Yeah.
plenty of CPAs who they only talk to their clients once a year, and it's usually on like December 30th. Like, whoa, just saw that you're making a lot of money. If you want to lower your tax bill, go buy a bunch of trucks. And then every dealership's selling a bunch of white trucks on December
I
31st.
mean, that's a killer too, Paul. Like honestly, like we talk about this with our clients, but like they're like, "What do you mean? I have to give away like that truck? Like I'm not doing that. I just bought it." I'm like, "It's part of the bit. Like it's part of the bit. Like I just bought them a brand new truck." I'm like, "Yeah, you should have talked to me before. Like you did that if you knew you were going to sell. Like obviously, you need to operate the business in the ordinary course, and if you needed a new truck, one broke, that's fine. But if the truck was fine and you just wanted to get a new one because the whatever Joey wanted one, that that's a different story. But just to close the loop on networking capital, I guess we have a whole deck that we go over with all our clients at the beginning that explains kind of what we talked about in more detail, as well as produce a high level model of an estimated sale transaction with proceeds. So the client is not surprised, as surprised, I'd say, when we get towards the end, because we say, no, look, we went over this with you. Remember, like we showed you, you get a net reduction for debt. We modeled in payroll accruals, we modeled in our fee, we modeled in the lawyer's fee. So it's actually we're very close most of the time to what we initially project. So it's just all making people understand because they never done this before, right? They know their business, they're the best at operating their business, but this is brain surgery. It is, right? You wouldn't do that yourself. You wouldn't do a double bypass surgery yourself. You need an expert that all they do is this, and that's why you hired them. So it's important to kind of listen to them. Not that you shouldn't make the decisions in the deal. All clients ultimately make the decisions, but in terms of the technical stuff, we really are able to add a lot of value.
Awesome. One of the last questions I have before we start wrapping up, you had mentioned like a pre-sale quality of earnings because you see messy books as much as I see messy books. Um,
In everything.
is that uh, how does that like how does that affect the value when it comes to, I mean, you alluded to a little bit, it gives a buyer confidence, but like from a valuation standpoint, or even just the cost standpoint of how much is it going to cost to get this cleaned up and do all these things. But like I see way too many businesses who are like, they hired a bookkeeper when they started just because everyone told them they need a bookkeeper, and the bookkeeper is sufficient for tax purposes. CPA
Yep.
grabs their QuickBooks, you owe this amount in taxes, see you next year. But most of the time, their bookkeeper is not actually like doing a lot of great things to actually give them data to operate the business. So but the business owner doesn't know what they don't know. They just assume, oh, I needed a bookkeeper, and I hired one, and so recommended them. So, but now they're getting ready to sell, and then they realize, whoa, we've got kind of a mess on our hands. Usually by having a conversation with someone like yourself.
Yep.
How does that affect the value? And then, what does that look like as far as getting it, cleaned up, quality of earnings, all that kind of stuff?
So I'd say sometimes it's not fixable with the quality of earnings, right? Sometimes it's so bad that we have to tell the client you need to hire a new bookkeeper and fix these things and get that on paper for 6 to 12 months, and then come back to us. But most of the time, vast majority of the time, it is fixable with the quality of earnings. So what does the quality of earnings do? It's supposed to take the trailing 12 months plus the previous year or two and make it full accrual GAAP basis, right? That's kind of what it's supposed to do and show the adjusted EBITDA. So our providers, we have a bunch we work with, very good ones. We work directly with them to kind of go through that process. And it's about, give or get based on the size of the business and the scope, I'd say anywhere from $30,000 to $75,000 on, give or take. That's what it costs. So it's not cheap, right? But there's data out there, I don't have it in front of me, that shows if you do have a pre-sale quality of earnings done, you get I think it's almost a full turn on your multiple of EBITDA as additional purchase price based on like stats they took on valuation. So do the math, right? If your EBITDA is $1 million and you just got another, instead of getting 7 times, you got 8 times because of this, you just made $1 million more and you only paid $50,000 for this report. And it's, and it is a deduction too. So you made out pretty good, right? So I think it's just super important because number one, it does increase the multiple in general based on stats. Number two, which kind of isn't directly to your question about the valuation, it just improves the whole speed of the transaction, right? You don't want to be doing this a day more than you have to, right? Every day that you go on with me, dealing with me, and we move super fast for this reason, right? We don't rush, but we move super fast. Time kills all deals. It's the truest statement in M&A in deals, right? You're distracted. You're running your business. We're bothering you for questions left and right. And the buyer's asking questions. They're focused on you right now, right? You want to keep them focused on you. Otherwise, they could find someone else. They could go do something, or the business could decline, right? Something could happen. Your GM could leave. Anything could happen. So we try to shepherd it through as quick as possible once the client is ready to go. And having a pre-sale quality of earnings gets in front of all those questions that the buyers would ask that could kill the deal and allows them to move a lot quicker and more confidently through the due diligence process, all of which inherently factors into the valuation. But ultimately, in addition, and then I'll pause, is the quality of earnings people along with us are supposed to look for additional add backs too that you may not have known about and validate them. So maybe you forgot that, you went on 2 trips to Europe and expensed $30,000 through the business last year. Not that that's ever happened before, right? But they'll look at that and say, "Hey, what was this?" And it's like, "Oh yeah, that's right," and that's an add back. Ultimately, if they find even more add backs than their price too, it justifies the fee by dollar perspective. So there's a lot of ways it's important, and it is considered market now. I'd say for deals probably above $1 million of EBITDA, the buyers expect it now. So that's my thought on that.
Yeah, no, that's super insightful. So as we kind of start to wrap this thing up, we've talked about a lot of different things, a lot of things to avoid, a lot of things to do. Super valuable. So appreciate all the insight, Rick. What would you tell owners listening right now? They're doing between $3 million and $10 million. And you alluded to this beginning, and I'm 100% on board with your thought process. But way too many owners think, well, if I just do more revenue, it's going to solve these problems. If they are struggling at $5 million and there is no cash flow, what would you tell them if they still believe, well, if they just get to 7 or 8 million, it's going to solve their problem?
It's ultimately just math, Paul, right? Like the revenue does not equate directly to adjusted EBITDA, right? And the buyer's paying for adjusted EBITDA. That's what they're paying for. So if you increase the revenue, but your margin, your adjusted EBITDA margin, your gross margin is not, is going down with the increase in revenue, something's going on, right? Either in your cost of goods sold is increasing and you're not offsetting your price accordingly, or your OpEx is exploding. You're not, again, raising prices. It's all kind of reflective of how you price according to your costs, right? So you should know these inherent KPIs or key performance indicators. Track them monthly. It's so important. A lot of people, they're so busy. It's understandable. But if you want to sell your business, it's all about your margin, your adjusted EBITDA, and your quality of revenue. Focus on those things. Track them. Increase them. Ultimately that's what it's going to come down to. And listen, we've done 5 plumbing, electrical, HVAC transactions in the last, I think, 18 months. No one loves these guys more and girls more than me. We love dealing with these people, but let's be honest, accounting is not usually their bread and butter. So get a great CPA. Get someone like you, Paul, to help them, like maintain it, track it, have a plan. Lean on these experts so that when you're ready, it's a more seamless transaction and we can have a successful closing.
Beautiful. Rick, thank you again for coming on the show today. If our
Yeah.
listeners want to connect with you, what's the best way for them to do so?
You could email me at rick@commonwealth, MNA, that's Mary Nancy Apple.com, or our business phone number is 215-801-3339, based in suburban Philadelphia. But we have clients all over the country.
Rick, it's awesome. Guys, this is how professionals on the financial side of the trades look at things. If this episode resonated with you and you are ready to get your business financially healthy, head on over to the bluecollaradvisors.com. Until next time, make it a great day.